Now, in the wake of the financial crisis, investment innovations such as new asset classes and asset allocation techniques have largely been given bad press. Despite that, though, a global survey of asset managers has found that, on the whole, these products aren't all bad. A joint report by Principal Global Investors and Create Research says that investment innovations can work as long as we know their limits. Now, the key is to align investment products closely with clients' needs. Well, joining me now is Jim McCaughan. He is CEO of Principal Global Investors. He oversees activities across asset classes and market regions, and his primary responsibility is for the strategic development of Principal's asset management businesses around the world. Well, prior to his current role, he has also served as CEO of the Americas at Credit Suisse Asset Management. Jim, thank you so much for coming. It's a pleasure to have you in the studio again. Talk to me a little bit about your survey, because we're talking about, branching out, but that introduction was very clear. It's
Yes.
fine as long as you know exactly what you're getting into, and I guess if you know the pitfalls. What is the number one advice for people that want to look at other assets that you would give to them?
I think that the number one piece of advice, and it's clear that this is how particularly the clients of the investment institutions are thinking about it going forward, is to think about the client needs and think about the risks being run. Because the areas that went wrong during the financial crisis were where excess leverage, structured products, led to vulnerable products under stress. Whereas the things that went right were those investment categories which expanded the investment horizons and created stronger returns, notably emerging markets and high-yield bonds. Those were the good innovations. The bad innovations were around excess leverage and structured products.
In terms of the structured products, Jim, I wonder whether, what we're coming out of Basel and these extra capital requirements, they're going to really crack down on risk, I guess, that the banks can hold. Will it also have an impact on the services and the new asset classes that these banks will provide?
I think it might. But there's a lot of talk about greater transparency. I am a little skeptical of some of that in the banking sector. It's still the case, for example, that much of the Greek debt we're talking about this morning is held on bank balance sheets as a banking asset. So in other words, because it's still paying, it's unimpaired. I think that's a lack of transparency which is quite regrettable. And it's actually very hard, looking at European banks, to be totally hand on heart honest about what's going to happen when Greece defaults. So there's an example where transparency is needed, and
to understand the market. It's just basically to understand what's going on, because otherwise, if you don't understand your exposure, you don't understand your risk.
Yeah, and that goes back to the innovation study, because a lot of what was going on in the run-up to the financial crisis, in the boom years of 2006-07, early 2008, is that clients were seeking high returns. Now, they didn't really put it this way, but they were actually seeking high leverage. And that was a pretty foolish thing to do, actually, and turned out very badly. Those of us in the investment industry who tried to keep leverage under control lost out on opportunities. And I think one of the lessons for asset managers is you don't necessarily want to provide everything that clients are buying. Sometimes the excess leverage is such that it's better to stay on the sidelines.
That's a good tip, Jim. Thank you so much for coming in.